Hi everybody, we've got a really busy week coming up for you in markets with yet another Brexit deadline and resulting EU summit, the April ECB meeting and the kickoff of US Q1 earnings season. Now, as always, we start with the economic calendar. Now, given that Germany has had a pretty horrendous run of economic data, and we have the ECB later this week, I think Germany's trade balance will be more scrutinised than usual, perhaps. The consensus is for a bigger surplus, so that obviously is good for Germany, should be good for the euro, but any disappointment could be felt via further declines in the euro. And as we're going to mention a couple of times here, euro dollar right in around that 112 vicinity, the bottom of its multi-month range. US CPI is always a big one for the dollar. I'll be watching dollar yen and gold for their reaction to this data. Dollar yen is back at key 112 resistance and gold is back to 1280, a big support level. We're expecting a fairly decent pickup from 1.5% in February to 1.8% year over year, that is, in March. So theoretically, if the data comes in line or better, we could break those levels. The ECB's one to watch for the week, the big one to watch for the week, though of course it won't be the decision itself that gets much interest versus the press conference afterwards. I'll touch more on this momentarily. There's also the minutes from the last somewhat controversial Fed meeting where policymakers stepped up the dovishness by forecasting no rate hikes in 2019. One would assume these contain a lot more talk about global risks and a lot less talk about what has generally been decent domestic strength. Then lastly, just because it's a hot button issue with the US-China trade talks, we also have China's USD trade balance out this week. Then as far as corporate earnings, the ones I'll be monitoring are shown here. From a UK perspective, Tesco will be a highlight, while over in the US, it's the big banks, JP Morgan and Wells Fargo, that get Q1 earnings season unofficially started. So yes, of course, back to Brexit. We tried to avoid it last week, but we're back again. We can't really help it. There's a new deadline, although Theresa May has requested a new longer delay, and at the time of filming, we don't know whether that's been permitted. We probably aren't going to know that until sometime in the coming week, because she has decided to team up with opposition leader Jeremy Corbyn, as I'm sure you can't help but have heard on the news. And so the direction of travel seems to be a softer Brexit, and it has been for a while, and that's why the British pound has been trending higher. More specifically, the options starting to make their way to the surface are a Norway model via the single market, or probably more likely a Turkey-esque type model via the customs union. The kind of toss-up there is that via the Norway model, you have to accept the free movement of labour, and that would just obviously be breaking a major tenet, a major promise upon leaving the European Union in the referendum. So that seems unlikely, although possible. The Turkey model also breaks one of the ideas of Brexit, in that we will be able to organise our own free trade deals. If you're part of a customs union, there's a common external tariff. So you can't fight your own trade deals. You have to accept that common tariff that all the countries within it are accepting. But that is what the Labour Party and Jeremy Corbyn are requiring. Theresa May hasn't completely given up on her deal, but it looks like the Labour Party want to tack on the requirement that we stay in a customs union. So that obviously slightly increases the likelihood of a softer Brexit, hence the pound is still moving higher. But you could argue too that the chance of a no-deal Brexit is still going up. Things could go wrong here, and I think that explains why we're still below that key 133 handle in sterling dollar. And for cable in general, what has been the case, I think still remains the case for the time being, is that 132 to 133 area is a good sell zone, at least a place to look for possible sell trades. Once we get that confirmed breakout 133, then that's a different situation. We have the EU summit not long after all the talks next week in terms of Brexit, but we can only expect that the eurozone, that Europe is probably going to extend and pretend here. So we have the ECB meeting. No changes are expected in policy at this juncture, but minutes last week and speeches by Mario Draghi and Peter Prayet, who's the chief economist at the ECB, suggest the ECB is investigating how they could provide some relief to the banking sector. You just have to look at Deutsche Bank, Commerzbank in Germany, the country's two biggest lenders in merger talks at the moment because they're under such pressure. That's symptomatic of what's going on in general for European banks, obviously under pressure from the fact that there are such low interest rates, so it's difficult to make money from lending. So it remains to be seen what happens there, but they could tip their hat that they're really going for that in this meeting, but they probably won't, I would suggest. The next big step is the TLTROs, but probably no detail on those until we would expect probably the June meeting. Now, I am recording this pre-NFP, so things might have changed, but 112 is still in view, and what the ECB say here in this meeting this week could determine whether this level holds. So as usual, it's the US banks that will set the tone for the rest of US earnings season. The S&P 500 has had one of the best first quarters ever, so you would think that expectations for earnings are fairly decent. Not so, actually. According to FactSet, we're expecting a minus 3.9% average decline in the S&P 500 for Q1 in earnings. And if that does turn out to be the real decline, that would be the worst earnings decline since Q2 2016. On December 31st, earnings expectations were around 2.9%. So that's a drop of 7.2%. That's quite a hefty drop in earnings expectations in the space of a quarter. It's normally expectations drop going into earnings, but it's the 5-year average is actually 3.2%. So it's around double the normal drop in analyst expectations for the quarter. So obviously things getting a little bit pessimistic at the moment in terms of earnings, yet the market in general doing well. So there's a bit of disparity there. Potentially we're looking at a situation almost opposite to last year, where actually maybe companies can jump over a low bar rather than falling underneath a high bar, because expectations were very strong at this time last year because of the tax cuts and things. In terms of individual sectors looking for the rest of this earnings season, it's energy, materials and technology that are leading those earnings estimate revisions declines. Within technology, always obviously interesting, it's been Apple and Intel specifically, Micron Technology also. So those company earnings will be particularly ones to watch in case they can exceed those downbeaten expectations. Would be a good thing for the market. JP Morgan, probably the single biggest earnings release out this week. The stock is up 7.2% over the quarter. Thank you very much for watching. Good luck with trading this week. And if you want to see these videos as soon as they're released, please follow myself and LCG on YouTube and social media.